Welcome to our latest podcast. I'm Derek Barrow from Santander Asset Management. I'm joined once again today by our Global Head of Macro, Tactical Asset Allocation Alpha, Hayden Davis. How are you, Hayden?
I'm very well, thank you.
Excellent. So, UK inflation remains stubbornly high and has not fallen as it has in the US and the Eurozone. What is the outlook for UK inflation, and does this mean the Bank of England will need to keep on raising interest rates?
Well, certainly you're right to highlight that the most recent inflation figure in the UK was very disappointing. So inflation remains stuck above 10% and has been, I think, for 7 months now. Whereas in contrast, the US inflation has fallen from its peak of about 11.5% to more like 8.5 now, and Eurozone inflation was above 10 and it's fallen to 7. So it certainly looks as if the inflation in the UK is stubbornly high and perhaps a bit more ingrained than elsewhere. But actually, if you dig deeper into the figures, UK inflation doesn't look quite as bad as in comparison, but that's not to say that it looks good, of course. So economists like to focus on what they call core inflation. So this is underlying inflation that strips out volatile energy and food prices. And core underlying inflation in the UK on that measure is just above 6%. And in the US and the Eurozone, it's just below 6%. So on that measure, the UK doesn't look too bad in comparison. But the underlying message is that core inflation is much too high at 6%. So there's a reason why economists focus on this measure of inflation, because it's smoother than headline inflation. It's not affected by sudden shifts in energy prices, for example. And certainly central banks keep reiterating that whilst headline inflation in the US or the Eurozone might be coming down, core underlying inflation remains stubbornly high, and it seems very difficult to shift to a much slower rate of underlying inflation. That's the message that all the central banks are pushing out at the moment. So inflation everywhere is still too high for policymakers. Certainly with UK headline inflation staying above 10, with underlying inflation still stubbornly high at 6 in the UK, and wage inflation higher than the Bank of England would be comfortable with, it's a very difficult story to justify pausing on interest rates. However, with UK interest rates now at 4.25%, it does look as if maybe the Bank of England probably only has one more rise to go. And the reason for that is that there is evidence that obviously the economy is not really firing on all cylinders. So growth is stuttering along, and that ought to bring down inflation. And also there is sort of good reason to believe that headline inflation will fall noticeably by the end of the year. So economists are expecting headline inflation in the UK still above 10% to fall to around about 3.5% by the end of the year. And one of the main reasons for that is because energy prices are falling. So natural gas prices are noticeably lower than they were at the start of last year. So that should bring down inflation. And also, it looks as if maybe some of the other measures that are have been contributing to accelerating inflation will be slowing as well. So, as we've seen over the last year, inflation really has accelerated across everything that people buy. I think car insurance premiums have gone up 37%. That's not sustainable. And of course, one of the reasons why car insurance premiums have shot up is because used car prices shot up as a result of the disruptions to new car production during COVID. And as a result, people who have cars, those cars are worth more because the used car value has accelerated so much. Now, used car prices are falling now because people are finding it easier to buy a new car as the supply disruptions to car production lines are falling. So that is just one example where price inflation is starting to slow down. And as used car prices fall in value, we should see that car insurance premiums should, if they maybe even fall, but certainly won't be growing at quite the pace we've seen over the last year. So one example of why the inflation that we have seen probably isn't sustainable. And it's also true generally across the board as some of the bottlenecks that arose because of COVID, they start to ease, which means that some of the jumps in prices that we saw in a whole range of goods and services, they start to ease. So it looks as if inflation should fall noticeably by the end of the year. And core inflation, remember, inflation stripping out energy and food prices. Generally, economists expect that to reach about 3.5% in the UK, the Eurozone, and the US. So once again, it doesn't look as if the UK is the inflation laggard, as it were, even if the headline number is quite poor. And that should ensure that the Bank of England can probably get away with one more rate rise, and that ought to be sufficient to contain inflation and bring it down to much more sort of palatable levels.
Excellent, thank you. So economic growth has surprised policymakers, economists and investors with its strength over the past 6 months and has simply defied predictions of us going into a recession. Does this mean the major economies will avoid recession entirely?
So certainly, I suppose the best news was on the Eurozone. So last autumn, economists, investors were expecting quite a weak Eurozone economy and a Eurozone recession, the UK with it, all because of the acceleration and the jump we saw in natural gas prices last year because of the invasion of Ukraine. What happened was that actually activity held up very well because we had a very warm winter. So the jump in natural gas prices didn't have quite the effect that everyone thought it would do. In the case of the Eurozone and the UK, it does look as if maybe they will avoid recession. Certainly the Eurozone looks as if it will avoid recession. The UK is a bit more touch and go. So there's a possibility we are in recession now, and economists think growth will remain pretty weak the next quarter as well. So the UK may just about be in recession, but certainly not the kind of recession that economists were forecasting at the end of last year. The Bank of England last year was talking about the so-called bathtub recession, where the economy would be shrinking for every quarter in 2023 and every quarter in 2024. That's no longer the expectation. So certainly a much rosier outlook for the UK and the Eurozone. In the case of the US, growth again has surprised economists with its strength over the winter and the start of spring. But really, it's a case of recession postponed, not avoided. So there are already signs that the US economy is slowing quite noticeably. That's evident in the housing market, for example. But economists expect flat growth at best in the current quarter, and they are expecting in the second half of the year a noticeable contraction in activity. So whilst on the face of it, it looks as if the US economy is in pretty rude health, it's still the case that economists expect a recession, quite a shallow one by historical standards, but a recession. And that's because, of course, we've seen the Federal Reserve raise interest rates very sharply to the highest rate in 16 years, and that is having an impact. And we can particularly see that in manufacturing, which tends to be the sector of the economy that leads, and it's the service sector that follows. So the underlying message there is that it has been a better growth outlook. It's reasonably good news for the Eurozone and the UK, but in the US, there's still some pain to come.
Excellent, thank you, Hayden. So markets remain jittery after the failure of Silicon Valley Bank in March, the forced takeover of Credit Suisse, and most recently the collapse of First Republic. What is the outlook for markets, and will the turmoil in US banking stocks lead to a credit crunch?
So certainly the jitters in the markets, the sort of nervousness, particularly around banking stocks, is certainly going to cause perhaps a tightening of credit conditions. Banks will tighten their lending standards. They will make it harder to borrow. I'm not so sure I would use the phrase credit crunch, but certainly a credit squeeze. And I suppose that's not entirely unwanted. Remember that the Federal Reserve is trying to bring down inflation. It is trying to tighten financial conditions. And so it wants to make it harder and more expensive to get a loan. That is how it cools activity and brings inflation down. So the Federal Reserve certainly doesn't want a credit crunch, but it does want a squeeze of some sorts. And after its most recent increase in interest rates, the Federal Reserve acknowledged that the turmoil in banking stocks and in the banking sector was likely to lead to a further tightening of credit conditions over and above what it expected because of the way it had raised interest rates. But that wasn't entirely unwelcome. So in a sense, the turmoil in the banking sector is doing some of the Federal Reserve's work for it, which is why it's indicated that maybe it might be willing to pause raising interest rates at the next meeting. It thinks that it's already raising rates quite aggressively, policies in quite restrictive territory, but the further sort of squeeze of credit standards that will inevitably arise because of banks tightening their lending conditions and pulling back on lending as a result of the turmoil that we've seen. That's actually what it wants, and it thinks it will do some of its job for it. I think though it's important to put in context what has happened in the banking sector in the States. So we've seen three insured banks fail this year, and that's not actually unusual. I know we don't often think of banks failing, but every year there are usually a few banks in the US that fail. There are about over 4,000 insured banks in the US. There are a lot of banks. And for example, in 2020, 4 banks failed. I think in 2017, 8 banks failed. So every year, usually there's a handful of failed banks. So what we've seen so far does not necessarily mean that there's going to be a continued cascade of banking failures. Although it is the case that the bad loans that maybe banks have on their books, and indeed the losses that they've incurred on their portfolios of government bonds, that's certainly going to impact their profitability over the next few years, but it doesn't look as if it's going to be a reason for more banks to fail. And there may be a couple more that fail, and certainly the market's focusing on 2 or 3 other regional small banks in the US, but we don't think that this is the start of a much bigger problem like we saw in 2008. That said, because banks will be tightening their credit standards, that is going to obviously impact the economic outlook, and that is one of the reasons why economists and we think that there will be a recession in the US later in the year. As far as the market outlook concerned for bonds and equities, well, the Federal Reserve, as I said, has indicated that it's willing to pause on interest rates. It's pretty much admitted as much, and we think that it won't just be a pause; it'll be the end of the cycle of rising interest rates in the US, and that's soon to be followed by the Bank of England, and probably very soon to be followed by the European Central Bank as well. So the message there is, with interest rates peaking, that's good news for markets. It's particularly good news for bond markets. So we're quite positive on the outlook for government bonds and bonds in general. As we reach the peak in interest rates, that's usually quite a good environment for bond investors. As far as equity markets are concerned, well, in the short term, we're still a little bit positive. I do think that the better growth that we've seen, the improving growth outlook, particularly in the Eurozone and China as well, that is a reason for equity markets to push higher. A little bit more nervous about the US because we do expect it to fall into recession later in the year, which isn't normally a good environment for equity markets. But that said, investors have had a long time to get used to the idea of recession. Certainly, economists have been forecasting it for quite some time. So we don't necessarily think that the US recession would have a devastating impact on US equity prices, but there's still the possibility that US equity markets could be lower a bit later in the year than they currently are before pushing a little bit higher beyond that. So in the near term, certainly still positive on equities, but we are aware that that sort of growth outlook and the sort of the clouds over the US economic environment are a reason to stay a little bit alert on the outlook for equities there. But certainly, as far as bonds are concerned, they look very attractive indeed.
Excellent. Thank you, Hayden, for such a detailed update. Thank you for listening to our latest podcast. The views expressed in this podcast are the views and opinions of Santander Asset Management UK and do not constitute investment or financial advice. If you want to explore more of our views and insights, please visit our website at santanderassetmanagement.co.uk. If you require advice or guidance, we would recommend you contact your professional financial advisor. Thank you once again for listening to our podcast, and we look forward to speaking with you again soon.